Welcome to Capitalized. I'm Oluwanifemi Aderinto, real estate investor, developer, and founder of Aderinto Group. This shows your all-access pass to the rooms where real estate deals get done. Each week, I sit down with industry leaders, the syndicators, fund managers, builders, brokers, and capital raisers who are shaping the future of real estate. We dive into the strategies behind building our portfolios, talk through real-world deals, and uncover how the top players are scaling their businesses and creating lasting wealth. Whether you're an investor, developer, or just real estate curious, you'll get the unfiltered insight you can't find in a YouTube video or weekend seminar. This is the game from the people playing it at the highest level. Welcome to Capitalize. Subscribe now and get in the room. Today's guest is Shawn Griffith. He's a former financial developer and analyst who transitioned into multifamily real estate and has since become a general partner in over 698 units. With a strong analytical background, Shawn brings a sharp eye for deals and passion for helping others build wealth through real estate. Well, let me take it back. How did you start first in multifamily?
No, that's a great question. Like a lot of people, I read Robert Kiyosaki's book, Rich Dad, Poor Dad, and that kind of got me interested. And a friend of mine invited me to one of the weekend sessions with a local group here in Dallas. The first day they talked about single family, and they said, yeah, you can retire, you can replace your income with like 10, single families. I'm a math and computer science guy, so I did the math and going, yeah, it's probably more like 14 or 15, not because I was making a lot of money, because I realized that you're not going to be getting money from all 10 of them all the time. At some point, you're going to have some vacancy. So you got to plan that into your formula. Anyway, the next day they talked about multifamily, and that just made way more sense to me. Single family is good if you don't have, hardly any capital to start with.
Yeah.
So, you can start building a base. My partner in Craft Capital actually got started flipping houses. But I started investing as a limited partner about 13 or 14 years ago.
Okay.
And that first deal, to this day, I run into the guy that sponsored the deal and I look at him and go, you bastard, you ruined me. We got like 3.5 times our money and it cash flowed 12 to 14%.
Really?
I'm
Wow.
still looking for a deal that good.
Wow. Was that when the replacement cost was lower? Was that when you could buy at 20,000 a door?
Oh yeah.
Yeah.
Yeah,
Yeah.
we bought it was a 64 unit property, needed some work. He came in and put in the work, and we just exited our last deal with him, and he did about 3 times our money,
Oh,
although it
wow.
didn't cash flow as well, especially after they did the first refinance where we got all of our money back. So we bought that one like in 2016,
Okay.
and literally just closed a month or so ago.
You sold the property?
Yeah, it sold it completely.
Wow.
And because he had refinanced it twice in there, so we'd already gotten more than our original money back, and so that was a really good deal. And then during that time, he transitioned into oil and gas, so I followed him, and
Investments in oil
then
and gas? You
yeah,
said, okay.
and then I got started as a syndicator. Oh man, I guess it's been 4 years ago now.
Wow.
Um, and my wife and I were kind of looking at our finances and what we wanted retirement to be like, and we realized that, if we wanted to be able to have the retirement that we really wanted to be able to travel, we needed to do something different. And for us, that was moving money out of the stock market into alternate assets like real estate and oil and gas. And I started a company. We did syndication. We closed on our first deal November of 21 as general partners.
Is that Craft Capital?
No, that was on separately with my own company, TWT Multifamily.
Two
And
multifamily.
then the next deal I did, Gabe Kraft was involved in the deal, but he wasn't the lead on it. So we started to get to know each other a little bit. And then we were in a mastermind together and got to know each other better that way. And then he asked me to come on and said, hey, would you consider, coming in to work for me? And I said, sure. He goes, are you okay if we operate under my brand? I go, yeah, it sounds better than mine. I'm okay with
Yeah.
that. And he's a younger guy. He's planning on this for the long term. And he said, where do you want to be in 3 to 5 years? I said, honestly, I want to be in like a board of directors role or some kind of advisory capacity where I'm not involved in all the day-to-day monitoring and operations of the company. I want to look at reports once a month and I want to attend meetings maybe once a quarter or as needed. If they need me more often, I can jump in. And I said, I don't want to be, I want to be able to basically be anywhere and
Still be
be an advisor.
yeah.
Yeah.
Okay, so back to your first deal. What was your first ever deal that you was the GP on it, that you were the sponsor on the deal?
Yeah. So we closed on that November of 2021.
Wow,
Uh,
20.
86 units down in Cleburne, Texas.
Okay. Did it
It's an all
affect you at
bills
all?
paid property.
All bills paid.
Yeah. And it's been my best performing property to date.
Wow. Okay, so did you finance the loan in 2021, right?
I did what?
You financed the loan in 2021, right?
Oh, yeah.
So were you affected at all by the rate hikes and by anything like rate side, or did you guys choose to get a rate cap? Because I know a lot of people did a floating rate at that point.
I,
Best over.
it's kind of funny. My partners tried to talk me into doing floating rate debt. And I said, you know what? I said, the numbers work with fixed rate debt. And since this is my first deal, that's a lower risk option. And
Yeah,
anybody out there that's considering investing or invested in the past, floating rate debt has its place. But if you don't manage it properly, the thing you got to remember about leverage is yes, more leverage will make your returns better, but more leverage can also increase your losses if you're not careful
yeah,
and cause you more trouble.
yeah. No, I agree.
So it's really, I looked at it as a risk reduction strategy that I said, you know what, I'm going to go with fixed rate debt. And that's one of the reasons I'm still able to do distributions on that property is I don't have to worry about the rate changing every week.
Yeah. Wow. What percentage did you finance today? Was
I want to say it
great.
was like 3.89%.
Wow, that's an insanely good rate, especially for times like this.
Yeah.
Wow.
Well,
Okay.
that's one of the reasons that the properties, I could actually sell it for more than we bought it for, which right now is unusual because most properties have taken about a 30% haircut.
Yeah.
And that's because of the value of that loan, because I've got a 10-year assumable note on there.
Wow. At that same 3.29?
Yeah.
Wow. That's amazing. You was one of the lucky few because one of my business partners, he's out of Los Angeles. He sort of he got a floating rate loan in 2021. Him and his partners talked him into it. And right now their property's in distress. They've lost some money over it, and it's a shame. You know what I mean? It's a beautiful property. The
Oh,
property is
no.
well, but
My second GP deal, I'm not the lead on it. And I tried to convince the lead that no, you really do want to go fixed rate debt.
yeah.
And they didn't heed my advice. So they got a floating rate loan on it, and they only got a 2-year rate cap. So we had the lender starting year two made us escrow for the 3rd year rate cap, which that was the only thing the team hadn't put in their calculations. So any money that would have gone to distributions
Went to the rate
uh,
cap.
went into the rate cap, and we're selling that property at about a 30% loss.
Wow.
So if somebody invested 100K, they're going to
They
get 70.
lost. Wow. How do you deal with that with your investors? That's
You call
timely
them up
science
and you have the
situation.
conversation, and you go, you have to be open and honest with people. You can't hide it. Yes, it is a bitch of a conversation, pardon my French, but it's a very difficult conversation to
No,
have.
I agree.
But you still have to have the conversation. You can't just be bearer of good news, right? You have to let the investors know the good, the bad, and the ugly.
Yeah, I agree. And then what do you do? Did it make syndicating harder for you at all after that loss or after you've told investors you lost their money? Because I know that's a hard conversation.
No, surprisingly, I actually had 2 or 3 of the investors thank me for being open and honest with them. And we discussed the partnership's rationale for why we're going to go ahead and sell it now at a loss versus trying to extend the loan. Because every broker and lender that I've talked to, and there's been a bunch of them, they really don't see pricing improving significantly
Yeah,
over the next 12 to 18 months. So we could get a 1 year extension, which means we'd have to spend some money.
Yeah.
And that just means we'd be right back in the same situation we are today,
A year from now.
a year from now, with less money, less reserves, and you might get 75 to 80% of your money back. Maybe. There, again, no guarantees.
Oh, yeah.
And everybody said, from the standpoint is let's go ahead and get out now while we can and put that money back to work somewhere else.
No, I agree.
So yeah, it's a tough conversation. I
It's
won't
pretty
kid
tough.
you. But that's one of those ones you don't send that out via email.
You have to call them
You
and
pick up
really,
the phone
yeah,
and call every single investor, and then you follow it up with an email.
yeah, yeah. I
Yeah,
agree.
yeah, yeah. It's all about the personal conversations.
And they'll respect you more. They'll respect you 100 times more just for being able to have that phone call and really have that tough conversation. 'Cause a lot of people would
Yeah.
went the email route. Yeah.
Well, it's just like my buddy that does oil and gas. The first oil and gas deal we invested with him, did great. It cash flowed well. We got like, again, I want to say 3.5 times our money back when they sold it. The second oil and gas deal we were in was a mostly gas play, and natural gas has been very flat for the last several years. It's just now starting to turn back up. So there's been no distributions from it. It's like, okay, no big deal. The third one that we were in, they're actually in litigation with the operator because they admittedly did not do a good enough job of due diligence on the operator. And now I think eventually it'll all work out in our favor. But the one that we just invested in, they hit a monster of a well, and it's doing way beyond everybody's expectations. And then there's an added bonus that they've thrown in some Bitcoin mining with it as well. They're using the waste gas from the well. They call it flare gas. They usually just flare it off and burn it. They're using that to generate the electricity to run the Bitcoin mining operation.
Wow, that's an efficient way to do it.
Yeah.
Wow.
So,
Okay.
like I say, yeah, sharp guy. He's really got a lot going for him, and that's one of the reasons. You know, again, he was a good role model for me because any good, bad, or indifferent news, he would make sure we all knew what was going on and what he was thinking. He and his partner were thinking about it.
What was his name?
Jason Sharp.
Jason Sharp. Okay.
His company is CapX Ventures, CAPX Ventures.
CapEx Ventures.
And if anybody wants an introduction, I'm happy to make an introduction to him. Oil and gas isn't for everybody, just like real estate, multifamily or single family investing is not for everybody.
What's the main differences? Like, what's the main differences? I've never heard the oil and gas play.
So a couple of big differences is oil and gas doesn't have depreciation like multifamily, like real estate does. They have what's called intangible drilling cost. And that's the roughly the equivalent of real estate depreciation, but you get it, and again, depends on how it goes. Usually it's around 60 to 80% up front. So if you invest 100K, you could get, 75K literally taken off your taxable income. And then on any profit you make from it, you only pay tax on 85% of it because you get a 15% depletion allowance. Now, again, I'm not an attorney. I'm not a CPA. I don't play either one of them on TV. So you always want to talk with your own advisors, both legal and financial, to understand what their thoughts on it. Because if you ask a CPA if you ask 10 CPAs the same question, you'll probably get 10 or 12 different answers.
Yeah. Okay,
But
so
yeah, I can keep talking about oil and gas if you want me to.
yeah,
And there's a lot of different slices or flavors of oil and gas investing. So it's not like, oh, hey, I'm investing in oil and gas. It's like, well, are you buying land rights? Are you getting the oil and gas royalties because you own the mineral rights? Are you actually buying the land and the mineral rights? Are you just investing in the operator? again, there's a multitude of different ways to go about investing, just like real estate.
Yeah.
Now, there's a lot of different ways to invest in real estate. It all depends on your goals, your risk tolerance. You know, there's most risky form of oil and gas investing is what they call wildcatting, which means guys out there basically drilling holes in the ground looking for oil.
So
Just,
just
you
guessing.
know, not a whole lot of science or anything behind it. That is the absolute most risky. Now, if you hit one, it could pay off really big. Excuse me. The opposite end of the scale is what I like to call the multifamily rehab approach to oil and gas, where they buy an existing well field and maybe there's two or three wells already on it. They're either underproducing or they're shut in, which means they've turned them off. They come in, they do some rehab on those wells and bring them back up to production levels.
Okay.
And then they drill a new well to prove out the concept that yes, this field is still good. And then they turn around and they sell that to like one of the big guys.
Okay, that makes sense.
So that reduces the risk for like the Exxon Mobil's and the Shell oil and those kind of people.
Yeah. Okay. So let's shift back to the more of apartment investing. What is your apartment investing strategy? Like, what do you typically do? Are you a value add core plus person? Are you, and what is your investment thesis? Like, what do you typically look for?
So for multifamily, we are value add. Our buy box is 200 units, give or take, specifically in the Dallas Fort Worth area. We really like the mid cities area, which is Hurst, Euless, and Bedford, which is exactly where you'd think it'd be. It's kind of midway between Dallas and Fort Worth. And, you know, we'd like to start getting into more newer stuff like 85 and newer, but so far everything we've bought's been like 60s and 70s
60s and 70s.
because that's what's penciled out.
Yeah, I agree.
Like our last deal we bought was a 70s properties, 195 units. We put $3 million into rehab on it.
And the capex budget,
I'm sorry?
you had about 3 million in capex.
Yeah.
Okay. What was the total cost of the property? Or how much did you guys buy the property for?
Because Texas is a non-disclosure state, I don't talk about the prices. Um,
Yeah, I understand. Yeah.
you know, I don't want to go on record for Tarrant County and Dallas County are kind of abusive when it comes to tax increases. So I don't want to give them,
So any leverage to
I
use?
want to make them work for it, you know.
Yeah.
Let's just say we bought it at a very attractive basis and we could turn around and sell it at market today and we wouldn't be hitting our pro forma numbers, but we would make money.
That's good. That's good. Yeah. How's that property performing currently?
Yesterday, hang on, I'm checking my email because I get a daily report. Let's see. That's their website pricing. So yesterday, to scroll down in the report, looks like we were, oh no, wait, sorry, that's the delinquency report, availability report. Okay, so yesterday we were at 95%.
Occupancy rate?
I'm sorry?
That's the occupancy rate?
Yeah.
That's really good. Congrats. Congrats.
Yeah. And you know, we've had some challenges, but you know, it was 69% when we took over.
How did you buy it on like floating rates? Or how were you guys able to get that? Because I know agency typically doesn't
Yeah,
depend on
agency
that.
wouldn't touch that. We
Yeah.
actually started down the path. It was 89% occupied when we started contract negotiations. And we were going down the agency debt path. We'd already put in the loan application. And then when they got the next set of financials, it had dropped to like 81%. And they go, yeah, you know, that 64% loan to value we were going to give you, it's more like 53% now. And we go,
Wow.
yeah, that doesn't work. So we had to go and we went with, floating rate bridge debt, which the bonus for that is we were able to finance the rehab.
Yeah. Also, the whole rehab was financed completely.
Yep.
Wow, that's good. That 3 million capex completely financed.
Yep.
Okay. So how much do you guys have to raise for that deal? And what was the process like for that for you guys?
I want to say it was like a hair over 10 million.
I hear over 10 million. And was it, I know you've been doing this for a while. Was it easy to raise or was it,
No,
yeah,
we got to about 6 or 7 million pretty easy, and then the last couple or so million was not as easy.
yeah,
And we had a couple of big check writers, which was nice, but still, it wasn't the deal that we've got under well, it's not quite under contract. We've got an accepted LOI, and we've done 2 rounds of negotiations and red lines on the contract. Assuming they sign the contract today or tomorrow, we'll probably have the money raised before they have the loan approved.
wow, good,
We've got people wanting to invest.
really.
And the only reason that's true is because, during this kind of downtime where there haven't been that many deals, we've still been in contact with all of our investors going, yeah, we're looking. Like so far this year, I think we've looked at over 120 deals just in the Dallas-Fort Worth area. And we don't look anywhere else right now. And out of those 120, we've probably underwritten about 70 of them. And out of that 70, we've put LOIs in on maybe 9 or 10. We made it to best and final on 2. A couple of them, they pulled back off the market because I don't think they were really interested in selling. I think they were just testing the market.
Yeah.
And then we've got this one that we're in negotiations with on the contract. You just have to stay after it. I mean,
Yeah.
it's been a slow couple of years. And I say that from a transaction standpoint, not an activity standpoint. We've still been, just because there aren't deals that are closing doesn't mean, we're putting our pencils down and taking a break.
Yeah. You have to stay active.
Yeah, for a couple of reasons. One, if the brokers know they can send you a deal and you'll give them feedback on the pricing, either verbally over the phone or by submitting an LOI, then that helps the brokers out because then they have something they can take back to the seller and go, well, here's what the market's telling us.
Yeah.
And we don't lowball offers, but we also don't go through the whole process of trying to drive a hard bargain. We look at it and go, can we make money on the deal at this price? And if the answer is yes, then we'll pursue it. Otherwise, the answer is no, and we don't.
Yeah.
We'll tell the brokers that. They're going, we'll tell them, say, well, we really don't like this deal, and here's why. Because maybe it's too small. We don't want to chase 60 and 70 unit properties.
Yeah, I agree.
Now we've got a friend that does, and so we'll say, hey, have you talked to so-and-so about it? And they'll go, okay.
Just refer to your friend. Yeah.
Well, and then if the broker ends up selling it, then now that broker kind of owes us a little bit. So the next time a deal comes up, they might give us an early look, or if we're in best and final, they may push the buyer our direction.
Yeah.
It's
the whole business relationships. Yeah. Okay, so when you first started let's say your first deal you ever sponsored and was a general partner on, how did you approach capital raising? Because I know a lot of people are scared with that. I know it's a very challenging topic for a lot of people. How did you approach it and how did you conquer it?
So one of the things I've learned is that whatever you're not good at, find somebody that you can partner with that is. And that's what makes a really good partnership. Because I take care of things that I know my partners don't want to do, and they take care of some of the things they know I don't want to do. And I happened to find the deal because I had put the word out in one of my communities that was in a mastermind group and said, "Hey, I'm looking for a deal." And one of the partners on the deal pinged me and said, "Hey, we've got this one that's up for sale. We'll give you an advanced look at it, but it's going on the market in like 2 or 3 days." And they already had it with the broker, and that's all fine. So I got an advanced look at it. I was able to put together a team, and we tried to come in and make a preemptive offer at a price that we knew that they would accept and take it off the market so we wouldn't have to go to best and final. Well, we weren't the only one that had that idea. Somebody else came back in and said, "Hey, we'll work on this." And so ended up being two of us in best and final. And anyway, long story short, we ended up winning the deal. But to answer your question about the capital raising part, the partners that I brought in were experienced syndicators. And of course, the very first question they asked me was, "How much money can you raise?"
Yeah.
I'm going, "I don't know, never raised capital before in my life." I said, what I will do though is I will commit to, 200K more than I'm going to put in myself.
Okay.
And they go, "Fair enough." It was a small raise. It was like 4 million. And they said, "We can raise the rest of it." Well, we got down to a month before and we weren't there. We still had $1 million left to raise. And my wife's a project manager. So she was every day, "You got to raise this much money today. You got to raise this much money tomorrow." So I called a friend of mine. I go, "Hey, Mike, buddy, I know you just finished a raise, but can you help me out here?" And he goes, "Well, how much do you need?" And I said, "A little over 1 million." He goes, "Let me make a couple of phone calls." And literally like 3 phone calls later, boom, we were done.
Really? Wow.
Yeah, he's a capital raising beast. I think last year he raised like $69 million.
$69 million.
Now, to be fair, he is not your average person, obviously.
Yes, he
He
a
and his
super
wife
social
owned their,
person.
yeah, he and his wife owned their own ATM company for like 28 years. So he has a very wide, very deep Rolodex of business owners.
Yeah.
So, and typically, successful business owners because they have cash.
Yeah. Wow. And
But yes, he is my capital raising inspiration.
he could just make a phone call and raise like this. Wow. Yeah. No, I know a lot of syndicators aspire to be at that point. Wow.
Yeah, well, and it's somebody asked him, and I think the very first capital raise he did, he had never raised capital before until he started doing syndication, and he raised $5 million.
First capital raise ever.
Yeah. Now, again, like I say, that's not normal.
Yeah. I know, but
And somebody asked him, he goes, "How long did it take you to get good at this?" He goes, "Like 28, 30 years." He said it's all about the relationship that he developed over that time. So, you've got to have that mindset that, you're always raising capital, but you're
yeah.
not asking people for money,
Yeah.
if that makes sense.
Yeah. So what is your approach when it comes to raising capital? Or do you more so offset that to your partners?
No, I always participate in the capital raising. My goal, like I said, my first deal, I committed to 200K. The next deal, I committed to 400K. The deal after that, I committed to 750, exceeded all three of those by a little. And on this last deal, the one we closed on in February, my goal was 1 million. I didn't quite hit it. I got to I think 800K. But my um, my approach is just constantly be putting it out there. When people ask what I do, I'm going, I raise capital for private equity investments in alternate assets.
So that's what you say? That's your quick liner?
That's my 5-second elevator pitch.
Yeah.
And if they're interested, they'll ask. And if they're not, then it's not worth my time usually.
Yeah. Wow. Would you say being active on social media, are you an active person on social media, LinkedIn?
I'm on LinkedIn. I am not as active as I was. Facebook, I'm active, but I mostly post about our travels. I mean, you can see by my background here, we like to travel. This was actually taken in Antarctica.
You've been to
And
Antarctica?
yeah, and the
Wow.
little yellow thing over my shoulder here is a six-person mini sub that we got to go down in.
Really?
That
Wow.
was cool.
That seems extremely cool.
But yeah, my wife and I love to travel, so I usually post about either like real estate events that I'm at or travels on Facebook.
Okay.
And that's really the two main ones that I do. My partners are very active on LinkedIn, um, but I'm not a huge social media guy.
Yeah, no, I understand.
I mean, you can't make a post on social media, even if you're doing a C, which does allow you to advertise. You can't just post and say, "Hey, I've got this awesome deal, send me money."
Yeah.
You've got to develop that relationship, and that takes time. So if you're ever thinking about raising capital, whether it's next week, next year, next decade, the time to start those
It's,
relationships is
it's now.
today.
Yeah.
Yeah, now. You got
Yeah.
to start now.
Yeah. So would you call yourself a very active person in Dallas? Like, are you a social person where you go out and try and meet people so you can raise capital? Or do you
Yes.
just, yes?
Yeah, I hit a lot of the local real estate meetups. I will also attend small business meetups so that I can meet other business owners.
Yeah.
Our target avatar is we've got a very well-defined avatar of who our target or ideal client is, and you've got to know who you're marketing to so you can know where to go find that person.
Yeah.
And it's it's not a group. It's not like, oh, well, I'm gonna market to small business owners. Well, that's too broad.
Yeah.
You know, we're focused on, CEOs that are in their, like early 40s. Our avatar is her name's Sarah Connor. She's 42 years old. She lives outside of Austin. She's got two kids. One's in high school, one's in college. And I've got like a page and a half of description that talks about who she is, what she's looking for, what's important to her. And we use that to drive our marketing. So anybody that is like Sarah Connor will be attracted by that marketing.
Wow. So you use the avatar just to sort of help configure your marketing, your advertisements,
Yeah.
and just market it
Because
towards a person like that.
one of the things I've learned, again, I'm not a big marketing person, but one of the things I've learned about marketing is that if you're marketing to everybody, you're marketing to nobody.
Yeah. But if it's defined and clear, you're gonna reach
Yeah.
your target audience.
hmm
Yeah.
And the more narrow you can make that, the better off you are. If you're marketing to everybody today and you make the decision tonight, hey, starting tomorrow, I'm going to only market to small businesses, or you've already greatly improved your odds. And the more you define that target audience, the better off you'll be in the long run.
Okay, so in 3 to 5 years, what is your goals for this? Or what is your overall goals with multifamily investing?
So, with multifamily investing in 3 to 5 years, I want to be a mostly limited partner. I will be still active in some deals as a general partner, but I will mostly be in an advisory capacity. That's my longer term goal. I will be involved as like a loan guarantor, or I'll have some other, maybe an investor relations role
Yeah.
with the team, but I'll have an investor relations person working for me that does the day-to-day stuff. For the craft capital investments, we just got through redoing our 10-year vision, mostly because the current 10-year vision we felt was pretty achievable and it didn't scare us. And we read the book called Traction by Gino Wickman, talking about the entrepreneurial operating system, which anybody out there that's trying to grow and scale their business, I strongly encourage them to read Traction. It's a great book. One of the things they said in there is if your vision doesn't scare you at least a little bit, then it's not big enough. And so we basically more than 10x'd our vision, and we're going to go way beyond just multifamily in the next 10 years.
Yeah. So do you guys, what do you consider spending into office, into industrial, other capacities, other investments?
We're actually spinning up a flex fund that should go live today or tomorrow that allows us to make offerings to other asset classes like triple net, small batch whiskey, RV parks, car
Yeah.
washes, you name it. We're going to be looking at a lot of different asset classes, but we're going to go in and vet the operators, and we've got a process defined for that.
Okay. So do you guys, are you typically a syndication model or a fund model?
We have previously been a syndication model, and we are pivoting toward a
The
fund
fund
model
model.
for all of the other asset classes. We're still going to keep a syndication model just for our multifamily. At least
Yeah.
that's the plan today.
I like the fund model because you can achieve a lot more based off just already having the previous capital. But I feel like just raising the capital in general for a fund is a lot harder than a
Mhm.
syndication. Yeah.
Yeah, one of the things that we're going to do with part of our fund model to help feed our flex fund is we're going to work with up and coming fund managers and get them connected with some training to help them build out and raise money for their fund and understand what's involved in the care and feeding of the fund. You can't just go, oh, I'm going to start a fund and then start taking money tomorrow.
Yeah.
There's a whole process you have to go through, which includes being vetted by the SEC. So if you're considering being a fund manager, which that's great, but I would recommend, reach out to me or one of my partners and let us, talk you through some of the pros and cons of it.
Yeah. So if you had to rebuild from zero, what's the first 90 days of your plan?
If I had to restart from zero, I would probably go out and flip a few houses to get some cash, invest that in probably a mid-size multifamily with some friends to get some cash flow going. Um, or potentially do like a fix and flip on some small multis. So like, 10, 20 units, buy them, fix them, and then flip them for an improved price. So it's kind of the same fix and flip model that you do on a house, but on a bigger scale.
Yeah.
Because one of my partners has done some luxury fix and flips. God, I need more coffee. Has done some luxury fix and flips and does really well with those.
Yeah. How do you balance the whole do you still work a job or is this your job?
This is my job.
Yeah. So how do you
And I
balance?
don't really think of it as a job. For me, this is just fun.
Yeah.
I get the opportunity to come on people's podcasts and talk about what I do. I get to go to some really great events around town. I travel to go to some other events. A couple of years ago, I went to Raise Fest. And, you know, I've got a mastermind or actually a couple of masterminds that I'm in, and they'll have events. Matter of fact, this weekend it's here in Dallas, so it's like literally right down the road from me, like 45 minutes. And the like Thursday, Friday, Saturday, I'll be hanging out with a whole bunch of other mastermind folks that are all millionaires or multimillionaires, which is way cool.
Yeah.
It's like I get to learn a lot from them, which is great. I mean, my background's I'm a math and computer science guy. So, when I got out of the Navy, I went to work for Texas Instruments, worked for them for 9.5 years, and they sold their defense group to Raytheon. And I worked for them for about another year and a half until they packed up and moved out of town. Didn't want to move to Tucson, Arizona, couldn't afford to move to Andover, Massachusetts. So I did some consulting work around town, ended up on a contracting gig with Southwest Airlines, worked for them for 14 years and retired. Went back east, helped take care of my dad for a couple of years and did some contract work. And then after dad passed away and the contracts dried up, came back to Dallas, spent the next 7 or 8 years building my multifamily portfolio and doing consulting work. And then I guess, been about 4 years ago now, I told them, hey guys, I got to quit. My CPA says I need to be a real estate professional this year. And of course, you get these blank looks because they have no idea what you're talking about. And I said, I'm giving you 4 weeks notice. I'm done. So I've been doing this for the last 4 years.
Wow. Yeah. And when you first quit your job and you were first getting into your first deal, was this your life? Well, did you have a balance between work and life, or was it just strictly work?
Not not from between when the contract is closed or when you sign the contract and you actually close the property because there's so much going on. There's so many different things that need to be looked after. That 2 month period is usually your entire life.
Yeah.
Now, did I do other stuff during there? Sure. There's just a lot of activity that has to go on to close that deal. Now, having a couple of experienced partners helped that a great deal because they were able to, take care of a few of the things that happened and guide me on what needed to get done. Because people don't think about it. Every time you buy a commercial property, you're essentially buying a new business.
Yeah.
And you have to spin up everything associated with running that business and the care and feeding of that business, including the accounting, bookkeeping, the tax reporting, the property management. Now, and this is one of those where, that's why we don't go after units, less than about 70 units because we want to have a full-time on-site property manager.
Yeah.
Because if you had to do all the stuff that they do for the takeover, I don't see how you'd get it all done by yourself.
Yeah.
I mean, you wouldn't sleep if you were trying to do it all yourself because there's just so much that has to happen.
Yeah. It's taking over completely, Brett. It's taking over a business.
Yeah, it is. I mean, you're starting a whole new business every time you buy a property.
Yeah.
And our model right now is, we buy, fix, and then sell in 5 years. That's the business model. Buy and hold for 5 years and then sell it.
Would you ever consider buying and just holding it and just?
We would, and we're actually doing that now. We're talking about building a blend of assets so that the company has one or more long-term assets that we're going
Yeah.
to buy for a long-term hold. We may go with some smaller properties there. And when I say smaller, I'm talking, like 80 to 100 units that we buy and just hold. But if we do that, we're going to buy it probably with just, 3 or 4 partners and not bring in any investors.
Yeah.
We may bring in investors and then in 3 to 5 years, buy out all
Refinance.
the investors.
Yeah. Would you do it through a refinance, or would it be strictly cash buyout and investors in that situation?
That's very dependent on the deal and the location, and the economics. In general, if you do a cash out refinance, rule of thumb is you're going to hold that property at least another 2 years, maybe another 4 or 5 years. That's not always true. If the market does like it did a few years ago, where the pricing just got crazy, you could do a cash out refi and then turn around and sell it in a year to 2 years and make even more money off of it.
Yeah.
If we were going to cash out refi a property, our plan would be to hold it for another probably 3 to 5 years.
3 to 5 years. So what is your thoughts on, like, the Burr method in flipping houses, or the Burr method in acquiring houses? Basically buy, renovate, rehab, and refinance, and just keep refinancing and refinancing. Do you think a model like that would work in multifamily?
It could, yeah. I mean, it's one of the things you got to look at. If you get the property at a good basis and you've got some room in there where let's say you buy the property at a really good basis and you only leverage it to 50%. Most lenders will go up to 70 to 80%. My general rule of thumb is I won't go past 70%. And that's just kind of my comfort level.
Why is that?
Well, you remember me saying earlier that leverage cuts both ways.
Yeah.
If you have more leverage, that's going to juice your return on the end. that's making a lot of assumptions right there. That's assuming that the economics are in your favor and that you're going to be able to sell it at a profit. If if things go sideways and your occupancy drops, well, now you're not going to be able to make debt coverage. If if you're only financed at, 50% leverage, you only have to make enough to cover a really low,
Amen. Yeah.
in relatively speaking, monthly payment. So, like I say, every deal is different. You just kind of have to look at the particulars of what makes sense for financing. Um, I mean, my partner Gabe is really the kind of the financing guru. He's very, very sharp about understanding the best financing to put on a deal.
Yeah. Do you have any kids?
I do. We have 4 kids between us.
Are any of them interested in multifamily investing or anything of the sort?
So we offered all 4 kids the opportunity to invest alongside us. The only one that took us up on it was the youngest boy, who's the second youngest child. It's girl, boy, 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 and he's actually invested in several of our deals.
Wow.
And he also understands, the business operation side of things, because he does a lot of stuff for us in the business. He does a lot of our like basic accounting, keeps our QuickBooks, keeps up with all my receipts, nags
Yeah.
me when I can't find a receipt that's supposed to be in the receipt bucket.
Wow.
So, yep.
Would you ever have thoughts of passing the torch on to your children? Like when you truly do end up retiring or passing?
Maybe he would be the primary candidate. The girl has also expressed business interest, but not necessarily in this business. So the other two, no.
uh, And any advice to anybody that's younger, let's say 20 years old, that wants to get to a place where you're at, what advice would you give them?
Don't wait to start as long as I did. I really didn't start until I was, I guess, almost 50. Um, I would, you know, you're young, you have time in your favor in theory. None of us know how long we're going to live, but um, educate yourself a little bit, figure out a plan that works for you and fits your lifestyle. How much time do you have to study? How much time do you have to take action? Because knowledge without action is useless. You can be the smartest real estate person on the planet, and if you never buy anything, never make any transactions, what good's that knowledge done you?
Just like everybody else, yeah.
Yeah. Somebody, matter of fact, is one of the guys in my mastermind group made the comment the other day, that if you want to be like the 1%, look around at what the 99% are doing and don't do that. Just plain and simple. You got to figure out what works for you and what you're willing to give up to achieve what you want to achieve. Wanting to achieve is one thing,
But actually doing it.
but being willing to step up and do what you need to do, is a different thing. Most people aren't willing to get out of their comfort zone. Another one of my mastermind friends had a great saying, he goes, nothing great ever happens in your comfort zone.
Yeah.
That's why it's comfortable.
Yeah. Do you think a person with a younger person that's trying to get into this, do you think they still can raise capital and do things like that, being such a young person?
I don't think they can. I know they can.
Yeah.
It's just a matter of you've got to build, like I said, it's really comes down to relationships. You've got to start building those relationships, and people go, oh, well, I can't do it because I work at a coffee shop, or I can't do it because I'm just a golf caddy or whatever. There's always an excuse, right?
Yeah.
If they don't want to do something. And, you just have to get in that habit of, asking people about what it is they do.
Yeah.
Um, I mean, like prime example, if I was looking at you as a potential investor, um, you know, I would say, Oluwanifemi, what is your what are you trying to accomplish today? And then I would shut up and let you answer.
Just let me talk. Yeah.
And then I would say, well, tell me a little bit more about that. Tell me, why are you doing this podcast?
Like right now,
Yeah.
well, I'm doing this podcast. I want to learn from people that have done it before, you know what I mean? And then sort of be an advocate for the younger generation that's trying to break into this and just be a source for knowledge. That's my goals with this.
And that's very admirable. And you can continue that conversation because we're in this format. You already have a bunch of questions you wanted to ask me, which is great. That shows that you were prepared. In a normal conversation, if you don't know what to say to somebody, ask them about their favorite topic, which is always going to be themselves.
Yeah.
And say, tell me about what you're working on now. And that'll open up a door because everybody loves to talk about whatever their latest project is.
Yeah.
Like with me, I'll say, what's the last great trip you went on? Because I love to talk travel. You get them talking about things they like to do, and then you start to get to know them. And then there'll be a point after a few minutes where they feel comfortable talking to you because you're sharing some common things. My biggest challenge is talking to people that are sports fans. I'm not a
Oh,
sports fan. I never have been. And so I can't ask them, well, hey, how about those Cowboys or whatever? I don't follow them. I don't know, so they would know right away I'm being very disingenuous. So you got to stick to what you know and what you do, and then ask them what they like to do.
okay. Last question. What's the best advice you've ever received about money or investing?
Warren Buffett, rule number one, don't lose money. Um, Seriously though, and the way you do that is you've got to do your homework and you've got to be risk averse. As you get older, you should probably be more risk averse. The time to take the risks is when you're younger and you're still 10 feet tall and bulletproof because you have time on your side to be able to earn money. One of the things, and you have to decide, you as an individual have to decide what's important to you for your lifestyle. You know, you don't have to be a millionaire if all you need is to cover your bills. And, let's say you've got passive income that covers all of your bills and you don't need to work, you've got all kinds of freedom. And if you want to travel or if you want to volunteer, or maybe you want to teach, there's a ton of options where prudent investing starting when you're young, like 20, 25, 30 even, you can build that passive income. And I guarantee you the first few years, you're going to look at it and go, well, this really isn't that much money. But if you're able to, make a few $100s a month out of passive income, well, now if for some reason you get fired from your job, if assuming you're working a job, or let's say you have a small company and all of your suppliers dry up and now you're out of business, your income stops, right? But if you've got a passive income over here that covers a few $100s a month, well, now that can help buy you time along with having a prudent emergency fund, which is why I always advocate people should have at least 6 months of expenses saved up somewhere, in an interest bearing account, a CD ladder, some way that where it's making more money than just sitting in the bank. There's a ton of options out there, but yeah, I could go on about that all day too.
Yeah. Okay. Thank you so much for your time. It was nice to meet you. Let me pause the recording.